Look, I cannot tell you exactly what will happen next year. I think one thing is very unlikely to happen, and that's a soft landing scenario. I think it's extremely difficult for the Fed to engineer a slowdown that is, just enough to bring inflation down, but not too much so as to push it towards a recession. So yes, my base case is a deep global recession because, I think the impact of all of those aggressive Fed hikes will finally be felt through the economy. But, it takes time. So there are complicated lags. And, I think at this point, the risk of a financial accident, basically rises.
Stephane, everybody likes a bear case, particularly when markets have been up to sort of judge what they've missed out on. But we've had a lot of bear activity this year. Still, then you go on to point out, well, there are risks of a financial accident. I mean, this is a fairly woeful scenario here. Are you just too downbeat on the prospects for next year?
No, look, so I think it's important to mention this is not my base case, right? I think the probability of a financial accident is rising, and it's probably higher than what people actually think. So it's not my base case, but it's certainly something that should be, definitely on your watch list. You need three things for a crisis, right? You need vulnerabilities in the system, you need a shock, and then you need, some mechanism that can exacerbate this shock and spread it through, the system. And I think investors basically underestimate the risks on all three of these dimensions.
Stephane, good morning to you. I don't understand the argument in some ways, I've got to be honest, and how our viewers would be able to monetize that. You don't think we're going to have a financial accident, but you think there's a possibility of a financial accident. So with all due respect, sir, what on earth are our viewers supposed to do with that when it's not your base case scenario, but you thought you'd tell us anyway?
Yes, I think you have to be very careful. I think it's all about risk management, right? You can play your base case the way you want it, but it's super important that because I think, the risks of a financial accident are still low, but they're still rising. So you want to make sure you manage your portfolio in such a way that, you can survive, a financial accident in case it does happen. So I think, this is really kind of what I'm trying to get at.
How
can they actually do it? Well, I think, first of all, don't give in to the fear of missing out. I think markets right now, you can just feel like people just want to go back to the excesses of the last year, the last 2 years, the last 10 years. I don't think we're going to go back to this kind of environment. So, what does it mean? It means, avoid the kind of, speculative growth stocks. Try to be diversified, try to hold some treasury bonds, some gold that could benefit if the economic environment becomes a little bit more difficult. Make sure you manage your risk, especially at Finimize, we love, retail investors. And I think, many of them, I don't think they can handle a 70, 80% loss. So, if you cannot handle such a loss, make sure you reduce your risk. And, more important of all, I think hold some cash because, high volatility will create some interesting opportunities. So you want to make sure, you've got the dry powder to profit from those opportunities.
Yeah, I mean, the challenging thing, as you're both pointing out, I think, is where do you go as a retail investor if indeed we begin to see more significant blockages in the financial plumbing. I just wonder whether the bond market at this point, given the level of debt and inflation we have, whether the bond market actually represents a safe haven or increasingly just another potential shoe to drop.
Yeah, I think it depends on your time horizon. I think in the short term, something can happen to bond markets because, as you mentioned, market liquidity is pretty low, both in treasury markets, but also in some corporate bond markets. So I think over the short term, something can happen. But I don't think I see, significant weaknesses over a kind of longer term horizon. So if you have a kind of longer term horizon, I still think, treasury bonds still make sense to, as an investment in your portfolio.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.